Starting from zero in 2026 with a low salary and a phone requires navigating a minefield of conflicting options. The moment you search for an investing platform, you are met with thousands of apps, each promising instant wealth, making it easy to pick a service that prioritizes its own profit over your security. You can bypass this confusion by applying a strict regulatory filter. Ensure any platform you use is covered by the FSCS, or your regional equivalent. This legal protection means that even if the app provider goes bankrupt, your capital is protected up to £120,000. Fees represent the second critical filter. While a small percentage charge might seem trivial today, these costs compound over decades, quietly stripping away significant portions of your eventual portfolio value. Setting these non-negotiable security boundaries immediately converts a chaotic gamble into a protected, controllable system. Many beginners fall into the trap of opening a standard trading account, not realizing they are volunteering to lose 10 to 20% of their future profits to capital gains tax. This is an avoidable leak in your wealth engine. To stop that leak, you utilize a stocks and shares ISA, or a Roth IRA if you are in the US. As this diagram shows, when your money sits inside this tax-advantaged shield, every dollar of growth balloons without being touched by the government. It is important to remember that the £20,000 limit only applies to your yearly deposits. It does not cap the total balance or the profit. Your account can grow past £1 million while the contribution limit resets every year, leaving your existing gains to compound tax-free. Protecting your growth from taxes before you purchase a single share is the highest leverage decision you can make as a beginner. The instinct to chase fast money through day trading ignores the statistical reality that 80 to 90% of traders lose their initial capital. It is a high-maintenance path that rarely beats the market. A more reliable approach is the Boglehead 3-fund portfolio, named after Vanguard founder John Bogle. This strategy focuses on steady, long-term growth and is built to survive the volatility of major market crashes. This strategy splits your capital into 3 specific baskets. First, put 55% into a U.S. stock index fund to own a fraction of the top 500 companies in America. Then, put 35% into an international fund to capture corporate growth from the rest of the world. The final 10% goes into a bond fund. These act as the portfolio shock absorbers, providing stability and steady interest to balance out the sharper movements of the stock market. Adopting this specific asset allocation shifts your position from a vulnerable speculator to a partial owner of the entire global economy. You don't need to master complex limit orders to begin. A simple market order executes your trade instantly at the current price, which is more than sufficient for a long-term strategy. Modern platforms also allow for fractional shares. This means you can own equity in premier global companies like Apple with just a few pounds, making high-priced stocks accessible to anyone with a phone. The math of compounding is shown clearly in this graph. By auto-investing £250 a month, you deposit £61,000 over 20 years. However, the interest earning interest pushes that total value to over £262,000. Wealth generation relies on this mechanical engine running automatically in the background of your life, rather than the luck of picking an individual winner. The diamond hands culture often encourages investors to hold on to hyped stocks with emotional loyalty. This often leads to a complete disaster, as people watch their savings vanish when the underlying business value shatters. You need rational triggers to sell. The first is when momentum dies. If a stock's price was purely driven by online hype and social trends rather than revenue, that price is fragile and will collapse once the attention moves elsewhere. A second reason to sell is when the market landscape changes. Elite investors like Warren Buffett will exit a position if management makes catastrophic decisions that permanently erode the company's competitive advantage. Buffett's decision to drop his stake in Tesco after an accounting scandal is a prime example. Once the fundamental trust in the leadership was gone, the reason for owning the stock vanished. Finally, sell if you have a superior real-world use for the capital. Reallocating your stock profits to fund a business you control or to purchase real estate can be a more strategic use of your money than leaving it in the market. These rules ground your exit strategy in data, replacing emotional panic with strategic reallocation. Historically, time spent in the market has proven more effective than attempting to time the market's movements. Compounding is a mathematical process that does not respond to your confidence or intelligence. It strictly rewards unbroken consistency and the patience to leave the system alone. Building a multi-million-dollar portfolio in 2026 is less about outsmarting the system and more about setting up a boring, automated process and giving it the years it needs to work.